Hi, everyone. This is Mark Potter, and this is an introduction to fundamental analysis of a company. I want you to think about the last things that you spent a fair amount of money on. Why'd you buy them? What did you like about them? And I also want you to look around and get an idea. Tell me what you see. What have other people bought? What's important to them? Did you buy it because it was inexpensive? It was good value? It had certain features that you liked? Um, it's expensive, but it was convenient. Perhaps you had to buy it, somebody else made you. Um, and then that's looking at things from a customer's lens. And if you look at it from an investor's view, which of the companies would you want to own and why? That's the genesis of fundamental analysis, looking at what companies do and how they do them to create value for customers and then ultimately investors. Then, when we think about that, how does it manifest in the company's financial metrics or fundamentals? So, what we're going to do in this presentation is talk a little bit about companies' fundamentals and companies' metrics to map them to a company's business model and how they create value to customers. So, companies tell stories about how they do what they do, and they do that through several different sets of metrics and reports. And one of the reports is simply called a balance sheet. It's just a picture at a point in time. It's a snapshot, if you will, of what the company owns, also called assets, and what the company owes, which are liabilities. And of course, if they own more than what they owe, what's left over belongs to the owners, the shareholders or stockholders. So the things that companies own are divided up between things that are short term in nature, and these current assets are things that tend to get converted to cash within a year. So cash is obviously cash. Accounts receivable, that's money that I'm going to collect from my customers, hopefully within a year. Inventory, hopefully I sell within a year. And then other short term assets. Then, of course, we have long term assets, and these are things that take longer than 1 year to get used up: property, plant, and equipment. Intangible assets, things that you can't hug, things like patents and trademarks and goodwill. And so companies own both short term and long term assets, but they probably borrowed money to buy them. And so companies owe money to other folks. If they owe them to banks or bondholders, this is called debt or notes payable, for example, on this slide. The notes payable is a current liability. That means that we owe somebody some money and we have to pay them within the next year. I also might have some long term debt, and that's money I owe to somebody else, and I'll pay them beyond 1 year from now. Then I might have money that I owe to my suppliers. Those are accounts payable. Other accrued expenses. So these are things that have been built up that the company hasn't yet paid for. Things like bonuses that employees might have earned through the year and they haven't been paid yet. So these current liabilities are things that we expect to get paid within the next year. And then long-term liabilities, and we owe beyond 1 year from now. So we might owe some taxes, some debt, and there might be some other things in there like pension responsibilities and other things that we owe perhaps customers to. So, for example, if a customer signs a software agreement and we're going to owe them service on that software agreement for 2 or 3 years, that's a liability. Finally, if our assets are greater than our liabilities, then we'll have something left over for the shareholders. And this is in the form of either investments that they put into the company when the company was born, things like common stock and preferred stock, or maybe the company has earned money over time. And so as the company earns money over time, that belongs to the shareholders to reinvest. And finally, sometimes companies buy back shares, they remove them from the market, and that will affect this treasury stock account. So let's take a look at a sample company. Let's look at Tesla's balance sheet for 2017. So this is their balance sheet. This came directly from Tesla's 10K, their annual report, and you can see that it looks a little bit more complicated than the simple version that we looked at, but generally a lot of the terms are going to be the same. So here's their assets that are listed and end here. So they've got 3.3 billion US in cash. They've got money that their customers owe them. They've got inventory on hand. And then they also have some prepaid expenses. So these are things that they've paid, but they have not gotten that service yet. So an example of that would be something like a utilities contract. So I might have, or insurance. So I've paid that in advance, but I haven't received the service yet. So we have about 6.5 billion of current assets. Long-term assets, you can see these are some large numbers. Property, plant, and equipment is around 10 billion. We can see some other assets that they own, vehicles, energy systems. We can see that there's at least some amount of intangible assets, that there's a little bit of goodwill, and there's a couple of other things in there. Total assets around $29 billion. On the liability side, you can see that they've got about 7.7 billion of short-term liabilities, mostly in the form of the first three things, which is money that they owe their vendors or their suppliers. Okay. Also, accrued liabilities. So these are things that have been baking, but they have not yet paid them. Again, one example might be contracts that they've received money for that they have not yet earned. Same thing with deferred revenue. My customers have prepaid or paid money for something. And so they've got about almost $2 billion in deferred revenue, and down here is customer deposits. So these are things that my customers and clients have paid me in advance, and I have not yet provided them with either the product, car, or the service, some sort of solar contract. So that's Tesla's short-term liabilities. Long-term liabilities, you can see that they have 23 billion of long-term liabilities, mostly in the form of of long-term debt or long-term deferred revenue. So 9 billion in long-term debt, for example. We're not going to go over each one of these accounts in this presentation. Then finally, the leftovers, what belongs to the shareholders. So you can see that shareholders, if you see common stock and paid in capital, that represents what shareholders originally put into the business to get it up and running. So shareholders have put over 9 billion US into the business to get it up and running. Then the business operates and they either make money or lose money. If they make money, it becomes retained earnings. If they lose money, then the retained earnings balance would be negative. In this balance sheet, Tesla chooses to call that accumulated deficit. So they have 5 billion of losses that have accumulated over time. Compare that with about 3 billion last year. So that gives us a lens into the company's current situation, that right now they have about 28 billion of assets, 23 billion of liabilities, and about 4 or 5 billion of equity left over, but mostly comes from the original investments that the owners made. The company's burning through cash, and that's something that we would expect with their business model. And we'll talk more about that in the coming slides. So another set of metrics that tell us about the fundamentals of a company is the company's income statement, which is just a listing out of what the company earns and what the company spends over time. And so here's a generic income statement. Revenue is always the top line. Then what it costs to build the product and deliver the product or service comes out first. That gives us gross profit as a subtotal. Then we have selling, general, administrative expenses, research and development as operating expenses that would come out next. Then we have financing related expenses, and that gives us our income before taxes. We take out taxes, and that gives us our net income, what's left over. So let's take a look at this for Tesla for 2017. Again, the most recent year currently published. So they sold a bunch of cars. And they sold some service for energy generation and storage. Their total revenue for 2017 was a shade under 12 billion US. But they had to make the cars, and they had to create the energy generation and storage and deliver that. And the cost to do that, to produce the cars, distribute the cars, produce and distribute the energy, is around 9.5 billion. The revenue was 11.7. The cost to produce the product and services 9.5. So 2.2 billion is what's left over. And so those are sort of direct costs of producing and delivering their products and services. But they have more expenses. So Tesla's all about the future. So they're putting 1.4 billion into research and development. They also have to pay administrative expenses, selling expenses to the tune of 2.5 billion. So now they're down to an operating loss of 1.6 billion, and they're not done with their expenses yet. Remember, they borrowed a bunch of money. They have to pay interest on that. So interest of about $470 million. And then they also have taxes, and depending on where they operate and what they're doing, generally, if you make money, you pay taxes. If you lose money, you may not have to pay taxes. But they have a total net loss, when all is said and done, of about 2.2 billion. Now, Tesla also owns some other companies, but they have a non-controlling interest. So how does that affect their bottom line? That has it's odd the way that this is built. Um, it's a double negative. So notice it says net loss attributable to these other interests, and it's a negative number. So it actually has a positive impact on their bottom line. We know that because they lost $2.2 billion before this, and only about 2 billion after. So their non-controlling interests in other firms had a slight positive influence on their overall financials. But either way, drop in the bucket. So what is that? It seems like a lot of money, but what is that on a per share basis? In other words, if you owned one share of Tesla stock, that's worth, as of yesterday, 278 bucks. So if you owned one share, you're an owner, they lost about $11.83. So that gives you some context for if that's a lot or a little bit. If the share cost $15 and they lost 11, then that says something very different than if the share is $300, $600, $800. So now we're starting to get a lens into the company's fundamentals by looking at what they own, what they owe, what they earn, and what they spend. Couple more things. The way that accounting works, companies use accounting methods that may or may not be aligned with cash flow coming in or going out. This is called accrual accounting. So what happens is that we also have to look at cash flows in addition to that. So say, for example, I gave you guys the example before. If my customer pays me cash, but I have not yet earned it by providing them with a product or service, then cash goes in, but I can't count it as revenue because I didn't earn it yet. Or on the flip side, let's say I buy a building, so cash goes out the door, but that building is not an expense that comes out of my income statement because I haven't done any activities associated with producing anything in that building. Once I do, then I'm going to match it against the revenue. I'll give you an example in a minute. So this is a very busy slide. We won't spend a ton of time on it. We're going to look at the highlights. This is Tesla's statement of cash flows. It's broken up into three pieces. First piece talks about operating activities, what they do for a living. They build and sell cars, they provide and distribute energy. Then the second section is associated with cash flow from investing activities. Investing activities is long-term asset purchases, property, plant, equipment, other companies, and the like. Third section, financing activities. Where do they get their financing from? Debt and equity. And there's some other smaller items as well, but primarily debt and equity. So where did the cash come in and where did it go out? So let me give you an example. Tesla, remember, they lost 0.2 billion from their operating activities in 2017. But look at their cash from operating activities was almost break even. Almost break even. And so we need both of these pieces of information to do an appropriate fundamental analysis of the company. Why the big difference between the earnings number and the cash flow number? The biggest difference has to do with non-cash expense called depreciation. So in other words, let's say this year in their operating activities, they sell a bunch of cars and they do that. They produce the cars in plants and they're using up those assets. They've got equipment, they've got a building, and that building is deteriorating a little bit. And so that building might have cost them 50 or 60 billion to produce total. And so what percentage did it deteriorate each year? Whatever percentage it deteriorated, you apply that to the overall and you get about 1.6 billion for Tesla. But it's not cash that went out the door. The cash went out the door when you bought the building several years ago. And so it's a non-cash expense, so it gets added back. It came out of our income statement, but it didn't affect cash, so we have to put it back in this statement. More on that later. But what about on the investing side? You can see that they purchased 3.4 billion of property, plant, and equipment. They also spent some money on some other things, but that was the biggest ticket item. What about financing activities? You can see that they repaid some debt last year. They borrowed 7 billion last year. There's a whole bunch of other smaller items, but those are the biggest ones. And so all in all, they've got cash inflow from their finance activities. They raised money, right? They raised money because they needed to reinvest for the future. So this gives us a lens into Tesla's financial picture, at least if we look at the raw financial statements, what they own and owe, what they've earned and spent, and cash coming in and cash going out. Now, you can see that after, the past 10 or 15 minutes, I've got a headache from looking at all these numbers. And so what happens is we try to simplify and encapsulate summaries of these by using a couple different tools. One is you look at a trend. Well, another is how do your numbers compare with a peer group? And then looking at other ratios and metrics. So these ratios, if you think about them, what questions do you want to answer if you're looking at the fundamentals of the company? There's all sorts of questions that I asked you at the beginning, the qualitative questions. There's also these metrics questions. How are they doing at paying their bills? Do they have enough money to get them through the next year? That talks to the company's liquidity or short-term solvency. Then what about long-term financial health and whether or not they've borrowed too much or whether they've used too much equity to finance the company? Those are long-term solvency or leverage ratios. How are they doing at managing their assets and operations? Collecting money from customers, paying suppliers. How are they managing their inventory? Those are asset management or turnover ratios. Then, of course, overall profitability. Then all four of these tend to come directly from the financial statements that we were just speaking of. And then if we connect them to the economics, like the stock price, how is the company doing? So these are different categories of financial ratios, and then we can more fully define or determine them. Know that there are many more ratios than this, and I'm just putting a sample up here that just help us display how a company is managing their firm. We're going to go through some examples of each. So there's a list of liquidity ratios, long-term solvency and financial leverage ratios, asset management ratios, profitability measures, and market value stats. So we can gross these up into something called the DuPont analysis, which helps us determine overall how a company is managing money. Look, there's too much data here. But remember, the data tell a story. What our goal is to get a sense of the data, determine which ratios are most important based on what the company does. So for example, if Tesla is all about future innovation, then I want to look a lot harder at their R&D portfolio and the time to market. Recently, they've been in the news because they've had some production issues. So I want to look at their asset management metrics, for example. If I'm analyzing EMC Dell or McDonald's, then I want to look at their inventory throughput. If I'm analyzing a company like Apple, I want to look at their profitability and again, their future innovation prospects. The return on equity is sort of like a final score. What did the company earn for the shareholders given what they've got invested into the business? And return on equity can be broken into component pieces. Net income over sales is the profit margin, and that's what you keep for every dollar that you sell. So if I sell $100 worth of product and I keep $4, then my margin is going to be 4%. Asset turnover is a productivity measure. What are you getting out of your assets? And so let's say, for example, you have, again, we have $100 in sales and you have 50 in assets, then your asset turnover measure is going to be 2.0. And then finally, the degree to which you use other people's money is the equity multiplier, or also called the financial leverage ratio. And so let's say you have 50 in assets and you have 20 in equity. Then the equity multiplier is going to be 2.5. So how does that help us? Well, these things, if you sort of cross off the common metrics, when you multiply these things together, gross up to back to our return on equity measure. So this drives our return on equity. So 4% times 2 times 2.5 is going to be 20. So I think I got that right. 4% times 2 is 8, times 2.5 gives me 20. So that means my return on equity will be 20%. So now think the reverse. You have a company whose return on equity is 20%. What's driving it? We've got a little bit of margin, we've got a little bit of productivity, and we've got a little bit of using other people's money. Well, what if you re-channeled your financial structure so that you had an equity multiplier? So if you use a little bit more debt, you might have an equity multiplier of 3, for example. What will that do to a company's return on equity? Now do the math. 4% times 2 gives me 8, times 3 gives me 24%. So a company adapting its financial structure to increase their multiplier can increase the return on equity from 20 to 24%. Just an example. We can discern the levers of return on equity by using this style of analysis. This is called the DuPont analysis. Let's take a look at some of Tesla's metrics. And so here we've got, this is the most recent year, and you can see these are some of those metrics that we talked about before. And what would happen is we'd take a look, again, this is a dashboard, and we'd try to discern, A, what are the most important metrics for this particular company, and how is the company managing these over time? So for example, we can look at a company's current ratio, and we can see that it is declining from 1.9 to around 1 over the past 5 years. And for a current ratio around 1 means that you're, on average, you have about just enough current assets to cover your current liabilities. 5 years ago, or 4 years ago, you had twice the current assets to cover your current liabilities. And so this is one of the possible reasons why they're raising additional cash by borrowing. They're doing this because they're growing. The faster a company grows, the more cash they consume. It's not necessarily a bad thing, but it's part of the dashboard that we have to poke around at. Also, if you look at average days inventory, so let's see, today or this past year, 80 days. So it took them 80 days to build their cars, for example, and then get them out the door to their customers. Compare that with 2 years ago, that was 113. 2 years ago, that was 130. So they're getting their inventory out the door much faster. That tends to have a positive impact on cash. How about making their payables, paying their suppliers? So we can look at these, and these will gross up into something called a cash conversion cycle. So how quickly can they convert their short-term assets to cash? Just an example. So we would look at all these, and we'd look at the trends. We'd rank the ratios that we think are most important. We can look at trends in profitability, trends in how they're managing their assets, short-term liquidity, long-term solvency, and we would compare it against a peer group. Tesla doesn't have an easy peer group, but we can look at other innovative car companies that are out there and also compare them to traditional car companies to tease out how much better they are at some things and how much worse they are at other things to see if it's worth it to own a piece of Tesla. As an investor, what would you rather own? Would you rather own Honda or Tesla? And so those are the types of questions that we can help answer by looking at companies' fundamentals. Some things to keep in mind. We have to always look at things into context. We should always look at original source data because there might be some things in the company's financials that are distorting year over year some of the numbers. There's not necessarily correct values. We have to, again, look at it in context. We want to look at some of that sort of final score, look at drivers of margin, then also try to rank the categories that are most important. So sometimes it's possible to find explanations by detangling and unpacking the levers that are beneath the ratios. But these are just some examples of how to unpack each of those components in the DuPont analysis of return on equity. Now, there's not underlying theory. So, although this says there's no way to know which ratios are most relevant, that's not quite right. You know by listening to things like this, you gain experience, you map it to their business model. If a company's business model is on operational excellence, like Walmart, then I would look at the operating metrics. If a company's business model is focused on innovation, then I look at their R&D portfolio, profitability, merger and acquisition strategy, things like that. So for diversified companies or companies that don't tend to have a peer group, you might have to get creative by doing some benchmarking. So instead of looking at another company in the same industry today, what did this company look like 5 years ago, the last time that they had a similar economic position? Looking at different accounting methods will be important, backing out extraordinary events. There was a company that I analyzed a few years back, and they had one-time expenses 10 years in a row. And so deciding what you want to do about that is important. And those are some things that you can get into at the next level of analysis. So that ends our introduction to fundamental analysis.